We've got many economists, one coming this afternoon from Brookings, who says that there is a recession. Are we in a recession
We
now?
are in a serious slowdown in the economy, which has very significant consequences for the public, and whether it's called a recession or not is of no consequence.
Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
What started in America last year has now spread to every part of the world.
We're down 9% today. The Xetra DAX over in Frankfurt is down by 9%. The Paris market down by 9%.
This could be the most serious recession in decades. And that means life, as most Americans know it, is about to change, in some cases dramatically.
Welcome to Market Makers, everybody. Your home for tomorrow's TA today. Often imitate it, never replicate it. What is with the thumbnail? A black canary. Black canary omen for the marketplace. If you guys watch CNBC or Bloomberg at all, every now and then you'll get one of these guys that come on and talk about the animal spirits in the marketplace. A little over a decade ago, Nassim Taleb wrote a best-selling book called The Black Swan about unforeseen market events. The inverse of that is a gray rhino, something that's easily foreseen, in my opinion, such as a recession. A black swan would be like the pandemic. Well, what's a black canary? It's a bad omen for the market that gives you a milestone for where you are in the cycle. I coined this term. I made this term up because we have a lot of black canaries in the marketplace. The genesis of the black canary, the inspiration of the black canary, if you will, goes back to colloquial English here in the United States of America. You've probably heard the expression canary in the coal mine, a warning, an omen. Back in the old days, think 1800s, early 1900s, they would take a songbird like a male canary in a cage down into the coal mine because oftentimes odorless gases could be released when you are mining. Highly toxic, highly hazardous profession. Anybody that's watched any videos on mining in general back then? And the canary, being very sensitive to these gases, would die. It would stop singing. So there would be a warning for the miners to get the hell out of the shaft. That's where I get this term from. But guys, we have black canaries all over the marketplace. One of the most obvious places we've been ranting on all year long is the cooked non-farm payroll numbers. We know that they were propping up these numbers to make it appear that the economy is super strong, right? Look at the inflation numbers. Look how low inflation is, even though inflation's at 26% embedded inflation. And if you can sit there and talk about how strong the economy is in an election year, then you should be able to win that election in a landslide, right? Because what U.S. citizen wouldn't want to keep the party in power that provided this fantastic, amazing economy? So they thought they could cook the books. And guys, and yes, I'm saying they cooked the books, but really, it's more of an observation than a subjective opinion, because when you look at what they did, remember that massive non-farm payroll report we had back in September showing this huge increase in jobs? When in reality, if you break that down, you see the true number. They did this to suppress unemployment. Peter Schiff broke it down for us.
In fact, according to Zero Hedge, but for the surge in government employment in the month of September, if you just back that out, right, and just maybe it was just a normal month, according to Zero Hedge, instead of the unemployment rate going from 4.2 to 4.1 the month before the election, it would have spiked all the way up to 4.5%. Now, that is a headline that the Harris administration does not want to run on. And so conveniently, we've had the biggest government hiring boom in history that was able to bring the official unemployment rate to 4.1.
The government set a monthly all-time high for hiring to give us that bogus bullshit jobs report. And then what happened in the last non-farm payrolls report? 12,000 jobs added, 12,000. And they're going to blame it on the hurricane. Blame it on what? They're going to blame it on the strikes, 12,000 jobs added. In reality, the government hired yet another 43,000 jobs. That job report would be negative. In the next revision, it may in fact be negative. At some point, remember my thesis for the trigger for the massive sell-off, you're going to get the rug pull on the numbers. Why? Because the Republican Party under Trump swept the whole U.S. system. They'll have the Senate, they'll have the House, they'll have the presidency. They have no benefit to keep cooking these numbers. So we're going to see at some point, could be December, could be January. Trump doesn't take office until January 20th. So who knows, December 6th, the next report, maybe that's still good, right? Maybe it's still good. We shall see. But these job revisions have been key. Remember, we revised these jobs down minus 818,000. Why is that significant? Because yet again, it's another 100% accurate indicator for predicting recessions.
And it's interesting, Bloomberg's Cameron Kreis has noted that in 3 decades of Bloomberg data, there has never been a cumulative one-year downward revision of 500,000 jobs or more without a recession. What do these revisions really say to you at the end of the day?
So we would expect the numbers to be off. This off is pretty dramatic. It's the largest that we've seen in 15, 16 years. It's about 1.5 times larger than any other downward revision that we've seen. So it's a pretty big deal.
You have to go back to the GFC cycle, and this was a greater job revision by a factor of 1.5 than this last massive job revision. And every single time you got a recession, understand the math and the market, understand where you are in the cycle. Lee, throw up the unemployment animation, please. Highlight the recessions in red. Guys, when does unemployment spike? It spikes during and after the recession. It is a leading indicator. If you're reacting to unemployment going up, you're going to be late and you're going to have a bunch of red bars on the screen. So we're going to look at this stuff in the charts as well, but understand how this will play out, because the best indicators for predicting recession that have 100% accuracy, Lee, throw up the SOM rule chart. Going back to 1953, Bank of America did this chart. Lee, highlight the column in red. Every single time for all 12 recessions, when this indicator triggered, and it already triggered in the summer, ladies and gentlemen, when this indicator triggered, you were already in a recession. The narrative will always be soft landing. Wall Street is at all-time highs for bonuses. They have a money motivation to keep small, dumb money, retail money, fully invested as long as possible for this decline. Lee, throw up the election rally slide real quick. We talked about this the other day, guys. This election phenomenon is really fascinating when you think about it. You look at the 2 biggest rallies in history. We're tied with 1928 now, right? 1928, 23% rally in the marketplace. What happened in 1929? The start of an 80% decline. 1928 was the election year. What about 1936? That was the election year. Massive rally up. And then what happened in 1937, 1938? The market declined 33%. Dow retracement. We're tied with that election year rally now. And then let's just look at the election cycle for this bubble cycle since the last 24 years now. What happened in 2000? Election year. What happened in 01? The massive crash. The Elmer Fudd of politics was inaugurated. Bush, the massive crash started that brought the NASDAQ down 80%, brought the S&P down 50%. Fast forward to Obama, 2008. That was right in the beginning, the midst of that crash really starting to kick off. 2008, you had the beginning of that crash. 2009, you had the bottom. Guys, that's where we are right now. 2024, your election year rally. 2025, I do believe, will be the breakdown. I'm going to show you some fascinating data here, and I'll show it to you as a corollary with gold as well. You're only going to get this on this channel because it's really interesting to see this. And Jeremy Grantham talks about the unemployment indicators as well. Lee, go ahead and roll that clip.
One of the best indicators of recession is a modest upturn in unemployment. And if you see that in a long-term chart, you'd be impressed. When the market ticks up 50 basis points, 0.5% in unemployment, 70% of the time it's followed by a recession. When it ticks up 0.6%, it is followed 100% of the time historically with a recession. Today it's 0.7. Today it is nicely, visibly above the level that historically has always predicted a recession. Recessions have this slippery habit of taking a little longer than you would like. It's not unique, by the way. They've done that a couple of times in the past. What they haven't done is wriggled off the hook. Once you get the leading indicators, such as the gap between the 90-day and the 10-year bond or whatever, the early warning indicators, and then you get the tick up in inflation, you have always had a recession. And that is the phase that we're in. So I would strongly bet, as a historian, I would just say, you've always had a recession in these conditions. Perhaps you'll get lucky. Perhaps this time will be very different from history. But this isn't 1 or 2 times. This is 8 or 9 times out of 8 or 9. You have always had a recession in modern times. And perhaps this will be an exception. I wouldn't hold my breath.
And guys, you already know about what happens after the first rate cut, because we've been harping on beating you in the head to death since the spring of this year. What happens after the first rate cut when you get that in the marketplace? Remember, we got the panic emergency rate cut of 50 basis points.
Secondly, why would we always forget that most of a market decline occurs after the first rate decrease, as you referred to? I mean, that takes talent, because that goes over and over again. We get enthusiastic about the first rate. Oh, just hang on, guys. Wait for the first rate cut. And then we're back to the races. And history is pretty clear. Most of the decline occurs after the first rate cut. Why do we forget it? Because that's who we are. We travel optimistically. And we like to forget unpleasant features.
The biggest declines always happen after the first rate cut. Markets are not about fundamentals. Let me save you so much time from watching TV. Markets are bullshit. They're Ponzi schemes. They are about euphoria. They are about FOMO. That's why you see these things price spike up to these ungodly numbers. Whether you're talking about crypto or equities, it doesn't matter. The cycle ends the same every single time. Every single time in my 20 plus years of trading, it has always been a soft landing forecasted. .com, GFC, and now it's always a soft landing, guys. Now, does this mean you're watching this, you can't go long? Guys, on Friday, I posted a Solana long on the Discord. That's already up like 18%. It popped 16% in just 48 hours after I posted it. We've had a trade on the Discord to be long on Bitcoin since 61K, and you're sitting up here in the low 90s. You can trade long, you can trade short. The cycle ends the same way every single time. Guys, if you want to join our Discord, hang out with our financial freedom seeking community, check out our website, marketmakers.trade. You can join the Discord straight through the website. I'll pin it in the YouTube comments, marketmakers.trade. And we have a website only exclusive package where you get all of our additional videos that we put up, our trades that we put up from myself and my staff, all available on the website. 2 different packages. You can try them out free for a week. If you don't like it, you can cancel it, but I think you're going to like it. So definitely check it out. Be sure to subscribe to the channel and like the video. And Lee, without further ado, let's go ahead and start the show. Lee was just asking me, how the hell did I come up with Black Canary? Well, Lee, I have a little bit of a confession to make. When it comes to markets and cycles and patterns, I'm a little bit like Alex Jones.
I'm going to be honest with you. I'm kind of retarded.
All right, guys. Guys, if you want to trade these markets, you can help support the channel. You can check out SimpleFX. Fantastic exchange. If you live outside the US, I'll pin that link and the YouTube comments as well. And if you want to trade all the cryptos with no KYC needed, no VPN needed, meaning if you live in the USA, you can trade there. That's Bitunix. I'll pin that in the YouTube comments as well. And of course, check out marketmakers.trade. All right, guys. So I promised you, I want to show you a corollary with gold. People have been asking me about the gold cycle, what I think's happening with gold, because this is really interesting to me. On the left is the GFC cycle for gold. On the right is the current cycle 2024 for gold. We're on a 3-day chart. Let's look at a couple similarities here. You have a nice long accumulation here starting in 2006. You got your breakout around September 2007. Over here on the right in the modern market with the pandemic, you had the move up and then you had a multi-year accumulation all the way basically to February of 2024 and then the breakout. But the key thing is to look at this in synchronicity with the market, the S&P. Let's start over here on 2007. When did the S&P top? On the 3-day chart here on the Wednesday, the 17th candle right here, the S&P topped. What did the market do? It continued to go up in gold and then it corrected. Let's measure this correction and see what this correction was. Over here, we made our peak in November, early November. We then corrected just about 9%, 8.65. Now, we don't know if the markets have topped yet, but we did almost achieve our 6,100 target on the S&P, and then gold started to roll over for retracement. Well, what's the current measurement of this retracement on gold, guys? Retracement on gold here took you to just about 9%. 9%, 9%. What did gold do next? Gold sat there and based a little bit in the GFC. Let's zoom this in so you can see this. It based a little bit while the markets topped. The market started to drop and gold did one more push higher, one more leg higher, a 33% expansion, a Dow expansion for its final top there in 08. And then by March of 08, remember gold ran up another 5 months to the spring equinox, March of 08. Then the markets were really starting to break down and sell off. And then what did gold do? It fell 34%. This is very important to understand, guys. It fell 34% with the markets declining. It bottomed in October of 08. Remember, the markets did not bottom until March of 2009. And then gold went parabolic. Look at the run. It went up 180% to its 2011 top. I think gold's going to repeat this same cycle. And as a canary in the coal mine, a black canary of what we're doing right now in the marketplace, we just are putting in this correction right now on your screen on the right, the same percentage drop we did, this pause before that final leg up. So let's look at this on the targets, right? Because if this plays out the same way, it'd be really interesting. If we take our Fibonacci retracement, go back to the 2011 peak. The 2011 peak, pull this down to your cycle low there, right around, where is this? On the weekly time frame, that's your November 2015 candle, November 30th, 2015, right? If you look back over here to the left, here's how that cycle played out, 181% gain. By the way, this is your commodity super cycle, not this crap. People telling you what's happening right now about going super long on commodities. Do you know what happens in recessions? Look at copper. Look at oil. Oil will get chopped in half when we have the actual midst of a recession. Commodities are not in demand. Commodities are in the most demand at a market bottom when all of the countries around the world are stimulating their economies, creating demand on a finite amount of commodities, then they spike, okay? So this was your super cycle here, 2011 top. Now, when you come over here, look at the targets for gold, and then we're going to get into the markets. Look what we hit. $27.95. We got within $5. I was setting up a short for the Discord here. We got within $5 of $27.95. We got the $27.90. We got a nice 9% drop here in the marketplace. So the key thing is is if we come back up and take out this high of 27.95, could it just top here? Sure. But if we can take out this high, that final leg for gold should take you to 3,336, right? That's where that final leg for gold should take you. You may be banging your head around here for a little bit, just like you did in the GFC cycle. So we'll see if we can break out above 2,800 to push to 3,336, and that would be the peak. And if you repeat that drop that you did in the GFC cycle, 34% decline, let's just take it from here. We'll take it from 3,300 on gold, bring it down 34%. 34% takes you right back down to 2,200 on gold, very close to the ceiling, this long multi-year accumulation. So I would think you'd come down to test the ceiling right around 2,100 here on gold. And then you go parabolic in gold. Then there's a parabolic move. Now, this is still a good move up here to get to 3,300, right? To get to 3,300 from your all-time high is still a nice move. It's still a 19.5%, 20% move. So we'll see. 2,800 is the key level to watch in gold. If it provides too much resistance, you build a bearish pattern. That's a trade for a short. If it can break through, then you're looking at it going to 3,300 potentially here on gold. Guys, let's talk about the cycle real quick, and then we're jumping to the S&P. I got Bitcoin and Solana on here as well, and of course the other equities. But let's look at how this played out. The GFC cycle played out back in the housing market crash, the Fed rate cuts. Remember, I was able to predict what the rate cuts would be. I gave you the 50 basis point prediction months before September 18th, and we cut on the exact same day because this is the GFC cycle. We went 50, right? Panic cut. We went 25. And then in December, we went 25 again. Hence, even though it's only a 50-50 chance we get a 25 basis point cut, I think you're getting a 25 basis point cut. Now, the key thing is, when did everything hit the fan? When did the shit hit the fan that the Fed realized Bernanke looked like an asshole because he's out there predicting a soft landing? It hit the fan in January 2008, right? That's when it hit the fan. This is because Fed Chair Bernanke called an emergency Fed meeting, and then their rate cut was 75 basis point cut. I think there's a high likelihood this plays out the exact same way. Come January, if we start getting the real jobs report numbers, unemployment starts spiking, you're going to see the realization of a material economic decline and Fed panic. Okay. So watch the January meeting. The December meeting is coming up as well. Look for the 25 cut in December, and we'll see if shit hits the fan come January. Let's go ahead and move forward. DXY is important to watch because we have this long basing process in the DXY. You broke out above 105.883. You're at 106.275. Will you just top out like this, right? Will you just top out like this and pull back again, give us a double top type pattern of a couple up thrusts in the range? Or are we going to hold this, make a higher low, maybe make our W pattern and start moving up? Remember, weaker dollar helps the markets do its next leg. If we look at the 10-year, 618 here on the Fibonacci retracement, right at 4.48 is the key resistance, and you have not been able to flip it. And I pointed this out on the Discord, guys. You have your 5% high, you have a lower high, you have a lower high, you have a low, you have a lower low. So even though the narrative on Bloomberg is, well, we could have real yields go up. I mean, they're so afraid that Trump's going to be inflationary. This could go up to 5%, 6%, 8%. That's the narrative. You got to break the trend. You have 3 lower highs in a row, 2 lower lows in a row. You're in a downward trend. You got to flip 4.48 to come up to have more material pressure here for higher 10-year yields, because eventually, as the Fed continues cutting, as I expect them to do in December, this will have a bias to turn back around eventually, okay? When the rate cuts are materialized, the VIX, even though we got that little spike the other day, you're still in a very low VIX, right? You're at 15.670, right down in that 15s. That's rally territory for the markets. And what are these markets doing? As you guys know, looking at the weekly pattern on S&P futures, this is ES. Looking at the weekly pattern here at 59.22, I'm looking for a key pivot here of the week of November 25th, which is what? Next week. So we'll see how this plays out. We have our target, our long-term target that we've had for the majority of this year, going back to the spring, 6,136, guys, 6,136. We got to 6,053. So I've been saying 6,100 to 6,150, right? That was the $50 chunks. We got to 5,000 or 6,050 into the 6,100 range. So when we look at this on the daily time frame, actually another weekly chart, here's your Fibonacci pitchfork. We bounced right off the 786. You're below the 618. I want to see this come back up. So let's look at this on the daily. So we had our supermoon, our last supermoon of the year. Remember, I told you if we rally into this, look for a pivot. Well, we peaked just a few days before the supermoon, and so far it's been the exact bottom. So when you look at your lunar cycles, remember, this is not an exact science, right? When you look at your lunar cycles, full moon, new moon, here's your full moon top. It took the market a few extra days to top. New moon brought the market down. Of course, here's a full moon top again, and then you got one more high, market retraced. New moon was the bottom, rallied back up to your full moon. This is where we traded, got the 200-point drop. The new moon was the day after the new moon was the exact bottom in the market. This super moon was the exact top in the market. Sometimes it hits the day of, just like that. And now we've started selling off a few days before the last super moon of the year. And now we're trying to rally back up. December 2nd, by the way, is the next lunar cycle for the new moon. Could we be rallying until then? Well, we have NVIDIA on Wednesday, which NVIDIA, I just heard on Bloomberg this morning, NVIDIA's market cap is more valuable than the DAX, which is a German market, the French market, the CAC, and the FTSE, the UK market combined, that one stock. And there's some news leakage about chip problems with Blackwell. You saw NVIDIA selling off a little bit today in anticipation of these earnings. Something else to consider about the concentration of NVIDIA's customers. So 4 companies are responsible for 40% of NVIDIA's purchases. 4 companies, the hyperscalers. Think about that. What's going to happen when those 4 companies are done buying chips? NVIDIA's profits could literally be cut in half, right? Huge stock, largest stock in the world, larger than multiple stock exchanges combined for some of these other regions. So what we're looking at here on the ES, guys, remember, I preach this all the time. Wave theory, law of 3, markets move in threes. You have your move up, your move back down to a retracement level. Now you're getting the counter trend to form. Want to see if we get a counter trend rally for what? A lower high, meaning below 6,053, or a false break to perhaps 6,000, 6,100 for your final high. That's the wave movement. So when we look at this from Fibonacci, we had our beautiful W pattern, our 5-wave pattern here. If we pull a fib from that all-time high down to that retracement level low, what's the key region to pay attention to here? That's going to be your kill box area, right? That's where you want to be paying attention. Let me grab a rectangle. Right here, 618, 786. Okay, I'll give you the prices. Right in this range. This is what you want to see if this holds for a reversal. So this would be 59.85 to 6,015 to see if price can climb back into the kill box and fades here. Hits its head, makes a bearish pattern, maybe smaller time frame, 1 hour, 4 hour, starts to break back down. Forming what? Forming this larger ABC right here, right? So this would be your ABC, your double top pattern, right? Your M pattern in the marketplace. ABC, decline. This would be, in my opinion, potentially the final top in the market. Now, if it can take this level out, take out 6,053, again, look up to the upside. Look where your 1618 is now from this range. Remember, Fibonacci measures proportional moves, expansionary moves, contraction moves. This gives you 6162. So if we get a strong counter trend rally, maybe NVIDIA has some blowout numbers again, lifts the whole Mag 7 sector once again, everything rallies, you take out 6,053. These targets remain the same for me because we have so much Fibonacci confluence at these levels. View it in $50 chunks. 6,050 to 6,100, 6,100 to 6,150, because we have multiple Fibonacci levels here from the giant ABC from the pandemic low to Fibonacci retracements, expansionary moves here up into this region. So I'm going to watch this area. 6100, 6150 is of keen interest if we can false break to the upside for one final high in the marketplace. The key levels you want to hold your low, obviously, but if we look at this from Fibonacci, let's go ahead and do it this way. Measure this, right? Let's see how much of this we retrace, how much of this sell-off came back from the Trump pump. You came right down to the 50% retracement, 5,888. You want to hold that level. The level beneath you, the most commonly retraced to fib, the 618, guys, 5,850. Maybe if NVIDIA shits the bed, you sell off down to 5,850. Totally normal. You want to hold that level. The level you don't want to lose is 5,724. If you take out 5,724, you're then coming back down to retest some of these key levels, okay? That's very bearish to take that out. As a matter of fact, where is the 50 on here? The 50 is above 5,724. It's basically at 5,815. So you'd be below the 50. This would be a very bearish move to take that out. So it's important to watch this marketplace. I'm looking for a counter trend rally to come back up, provide an opportunity to short if we hit our head. And if we can break out above it, then I'm looking for that 6,100, 6,150 level for the next blow off top, the final top, in my opinion, potentially in the marketplace, guys. Remember what the oscillators did with the selling. We go down to the smaller time frames. You go down to the 8 hour. You've had everything have an opportunity to wave down and reset. Momentum wave down. MFI wave down and reset for this next level push back up. Will it fail at peak resistance, or will it go up to give us our blow off top? Let's look at the Dow, see how this is playing out. Again, same type of move, guys. The Dow retraced to the 382. Very shallow retracement, 43,542. Looking for this double top ABC if the Dow fails. Key support level you don't want to lose here is right here. Oh, where's my one fib? Let me add this back on the chart. Key support level for the Dow, if this was just to tank, right? I just want to give you this level, not my expectation, 41,791. I think you're going to get this counter trend rally back up to the top, okay? But let's go ahead and look at this again from a Fibonacci perspective. Open the Dow up. This is Dow Futures, by the way. Dow Futures, we pull this fib from A to the current retracement low there. 618, 44,156, 786, 44,362. And of course, the 1618, if you put in a new high, want to watch 45,383 to the upside in confluence with the S&P if they decide to take out their all-time highs and move up for the final high. Okay, that's what we'll be watching there on the Dow. Let's look at NQ. This is NASDAQ futures. 20,623 is just been ultimate resistance here ever since we completed this giant ABC off the bottom, up a quadrupling from the pandemic low, a doubling in the marketplace, and you're struggling right back at 20,623. We look at this on the daily time frame. As you guys know, we can pull our fib here from 3 to 4. Looking at our 5-wave W pattern, you got just above the 1618 at 21,067. Big sell-off, right? You fell right to support at 20,483. Look at that, bouncing right off of it. Let's go ahead and remove this. Let's measure this retracement off of the Trump pump. Trump pump low to the high, all-time high, bouncing off the 618, 20,517. You're at 20,645. So what do we want to see here? If this waves back up for one more move, same thing, pull your fib from your all-time high down to that retracement level low. If this is the current low anyways, see where this rebounds up to. The kill box zone is going to be that 618, 786 right in here. See if you hit your head in here. 20,983. Let's call it 21K to 21,150. 21K to 21,150. See if your counter trend holds up in this area, or if NVIDIA allows you to spike up through this area, and then you want to watch almost 22K, 21,919 for that next wave up, if the NASDAQ can do that, okay? Continuing on. I put a couple of clown emojis here because this just struck me as really funny. This is the Russell futures, okay? So this clown emoji, remember back in August, I've talked about this a couple of times, but that's why I always tell you guys, I love watching Bloomberg and CNBC and listening to these analysts. So Tom Lee was saying back in August, he had a 40% rally going to occur in 8 weeks. 40% in 8 weeks. Okay. What happened? Well, just about 5-6 days later, we went up slightly here, a few points, and then we fell 14%. Right? We fell 14% after Tom Lee predicted a 40% rally in 8 weeks. So since then, you've been chopping in your ascending channel, rallying back up. Tom Lee last week said he expects the Russell to outperform the markets for years to come. Now, the hilarious thing here is that literally within 48 hours of him saying that, the Russell fell 6%. The guy top ticked the market twice for big, massive drops in the Russell every time he comes out and talks about how bullish he is on the Russell. Now, remember, Tom Lee, just like Eddie Ardeni, no recession prediction. He believes in a soft landing and everything's just going to go up. With these pushes up and these counter trend rallies, could we get new highs? Of course we can. That's why he gave you those targets. But right now on the Russell, guys, you also want to watch your Fibonacci resistance to the upside if this low holds, because you have the Russell at 2,400, 2,450, let's call it. See if it fades out and dies in that range. If it takes out the fractal high of 2,455, you want to watch 2,500, 2,550 to come back up. Okay. So we'll see how it all plays out and shakes out there on the Russell. DAX, same story, different day, guys. The DAX through our domed house pattern, head and shoulders, 5-wave pattern. You dip back below the 50 moving average. You retest it, your long-term Wyckoff ceiling here. You bounce back up to 19,217, trying to fight with that 50. If the markets can get that counter trend rally, one leg push back up, I would expect to see the DAX move up with it. Again, this is like a mid-range for me. This is not at any type of Fibonacci resistance. Higher resistance to the upside. The 786 is up here at 19.6. Maybe more interested up in here because you can see you had candles fade, but I would look for the DAX to move up. I would look for the US markets to move up and this counter trend fade move. So that's what we want to see. If the S&P takes out its fractal high, the NASDAQ could struggle because the NASDAQ beta tech often would top first, right? But because the Mag 7's been the leader for this whole cycle, the NASDAQ could make a new high too. But I want to see how the DAX reacts to this level. Key support level is 19K. You got to hold 19K or you're back in that lower range again. If we look at Bitcoin, guys, been over these wave movements in Bitcoin for our targets. You're at 91K here on Bitcoin. We go to our cycle low here on the, let's go ahead and put this back on the weekly so we can see this a little bit easier. Weekly, right? Pull this out. We have our giant ABC at 80,000 we flip. We get these wave movements. Put this up here. We're at 90% right now, almost 91%, matching that last signal wave, right? That last wave, 91%. So that's where we're matching at right now. And if we pull our fib and take it from that high, the previous all-time high, to that retracement low, we're above the 1618 still at 89,231. Again, if we can hold above it, if the markets can do a counter trend rally, then look for 98,742 to what? To 100K for the next key significant level. And again, that would give you a 100% leg in the market, 101%. Same leg you did here, same leg you did here. These average out to about 100%. So matching these prior legs, 98 to 100K Bitcoin is what I would be looking for. And people keep asking me, well, what happens if you flip 98 or 100K and you can hold it? What happens? Well, I just look at harmonic expansion at that point because the fibs have been playing out so beautifully here. We look at 2618, harmonic expansion. Target after that would be 114. Can it get there? I don't know. Got to see what happens here. I think the markets are looking to top very, very soon. We'll see if Bitcoin can run up here first. We got to test this 9,800K area, get up here, see if we can break above it or see if we start topping out right around that region, guys. If we look at this again, we can zoom into the 4-hour time frame. Here's a little Wyckoff trading range, 93.3. Down here to your low of 85. You want to hold 85. If you look at this on a 4-hour perspective, you have a low, you have a higher low, you have a higher low. Again, here's your 1618 from the larger time frame, 89,239. You're holding above it. Take out that fractal, 93,381. Next stop is 98,755. Want to hold 85K. Key to hold this range, okay? So we'll see what happens. But right now you're coiling, you're building up energy with higher lows. And I think you're going to get that little spring from this move to come test 98, 100K is the next move, I believe, in Bitcoin. If we look at Solana, Right now it's about 240. This got all the way up to 248, guys. So this was a great little trade that I put in here right in this consolidation accumulation range. Why? We've been talking about it on this channel because that was the fractal high holding above 210, right? We start stacking these candles above 210. So when we dip down below 208, 210 range, got a nice pump up in just 48 hours on this trade here. We had this at most 19.5% now. We got 16.5% in the first 48 hours. It's almost a 20% move. If Bitcoin can move up to that 100K, I think this is coming up to that 272, which is a nice 31% banger of a trade. So that's a lot of fun. Guys, hope you enjoyed this video. Leave me your questions, comments. As always, I will answer them. Check out marketmakers.trade because I hope to talk to you guys on the Discord as well. Guys, I'll see you in the next video. Have a fantastic week, everybody.
That the highest multiples do not predict good times, which you learn at business school, but have historically predicted the worst times. It should give you cause for some concern and some caution. And of course, the market does not feel concerned or cautious. It didn't in 1929. It didn't in Japan in 89. It didn't in the US before the housing bust of 07, 08. That's the way the market is. So, dear listener, get used to it. You will not be warned. The very best of times, it will feel like the highest possible pricing, the highest possible PEs will be followed not just by tough times, but some of the worst times that occur.